Welcome to Trading Day. I'm Andrew Bell. Let's get to the big stories we're bringing you from our newsroom. Gold and silver have hit record highs today. Look at that. Gold February futures above $4,600. Silver on fire once again. That's after the administration of U.S. President Donald Trump threatened the Federal Reserve Chair, Jerome Powell, with a criminal indictment. Powell said the move is a pretext to gain more influence over the central bank and monetary policy. Repeated attacks on the Fed by Trump have been a major factor, propelling gold and silver to record highs. Some former Fed chairs and Treasury secretaries are condemning this move by the Department of Justice, saying it will undermine the central bank's independence. Shares in Lululemon have sagged over the past year, but they're getting a boost today. The clothing seller said it expects fourth quarter sales to come in at the higher end of its forecast. Revenue is expected to be more than $3.5 billion US, thanks to strong holiday season revenue. This comes as Lulu's founder and Elliott Investment Management are pushing for changes and new board members. The CEO is set to step down at the end of this month. We are seeing selling in U.S. bank stocks after Trump called for a one-year cap on credit card interest rates at 10%. Trump says the cap would come into force on January 20th. But U.S. lawmakers say the move would require approval from Congress. A joint statement from 5 lenders said the cap would reduce credit availability and be devastating for millions of Americans. TSX hitting record highs today, boosted, you guessed it, in part by gold stocks. And we've also seen the S&P 500 south of the border hitting a new high. It's interesting, it opened down on this confrontation between the Fed and the White House. Bloomberg said the Sell America trade was coming to the fore again, but markets turning up, as you can see. Well, let's get to this extraordinary standoff between the Trump administration and the Federal Reserve Chair, Jerome Powell. Federal prosecutors in the U.S. have opened a criminal investigation into Powell, and he fired back in a video statement saying this is all about political pressure by the administration to intimidate the Fed over interest rates. ABC's Elizabeth Schultz has more.
Good evening.
In a rare public statement Sunday night, Federal Reserve Chair Jerome Powell confirming the Fed was served grand jury subpoenas as part of a probe into his testimony about the central bank's building renovation costs. But Powell says what the investigation is really about is retribution.
The threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public, rather than following the preferences of the president.
Since he took office, President Trump has repeatedly demanded the Federal Reserve slash interest rates. Powell insists the Fed won't bow to political pressure.
This is about whether the Fed will be able to continue to set interest rates based on evidence and economic conditions, or whether instead monetary policy will be directed by political pressure or intimidation.
Overnight, lawmakers denouncing the investigation into Powell. Republican Tom Tillis, a member of the Senate Banking Committee, threatening to withhold his vote for any nominee to replace the Fed chair, writing, if there were any remaining doubt whether advisors within the Trump administration are actively pushing to end the independence of the Federal Reserve, there should now be none. It is now the independence and credibility of the Department of Justice that are in question. President Trump now denying involvement in the investigation, saying, I don't know anything about it, but he's certainly not very good at the Fed. 2 weeks ago, Trump said this.
We're thinking about bringing a suit against Powell for incompetence. Because think of it, these aren't outstanding buildings. These are small buildings.
The $2.5 billion renovation of the Fed's Washington headquarters became a target of the president's during a tour of the construction site in July. Powell pushed back, saying Trump cited inaccurate numbers on the cost.
This came from us?
Yes. I don't know who does that.
You're including the Martin renovation. You just added
our entire capital plan.
Yeah, you just added in a third building is what that is. That's a third building.
Well, no,
including the
but
Martin building.
it's a building that's being built.
No, it was built 5 years ago. We finished Martin 5 years ago.
It's part of the overall work.
But it's
So,
not new.
So we're going to take a look.
Powell, who Trump handpicked to lead the Fed back in 2017 and has served at the central bank under 4 administrations, ends his term as chair in May. The president has said for months he wants Powell out sooner.
Let's get the latest on this from BNN Bloomberg's Lindsay Busquea. Lindsay.
And the latest is really that question of the Fed's independence today, Andy. We've got 3 former heads of the Federal Reserve as well as 4 former Treasury secretaries that are speaking out today saying this would undermine the central bank's independence and that this type of behavior is, quote, more characteristic of emerging markets than weak institutions. So some really strong words coming out today after this back and forth between the Trump administration and Jerome Powell. And I think it's really interesting to note that video that came out last night that Jerome Powell issued, that video statement, just how unprecedented that is to see the chair of a Federal Reserve do that, and particularly Jerome Powell, who's always been quite diplomatic, never actually speaking directly about Donald Trump, directly accusing him in this video of having a pretext with this story of these charges and saying that really the underlying issue here is that Donald Trump wants aggressive rate cuts and Jerome Powell has not been delivering what Donald Trump wants. So it's really interesting to see these calls of independence by the Federal Reserve coming forward. This is something we've seen before, something similar to what we've seen before. We were speaking earlier today with Ryan Young from Competitive Enterprise Institute, and he talked about something we saw during the Nixon era. Have a listen.
Nixon installed a Fed chair named Arthur Burns, who was a respected economist until he took that position, and then he essentially was Nixon's yes man. He did all the stimulus and easy money policy leading up to the 1972 and 74 elections that Nixon wanted, but it backfired because the trade-off to stimulus now is inflation later, and that's what caused a lot of the great stagflation that we saw in the 1970s.
We know Donald Trump saying he doesn't know anything about this. Kevin Hassett, another figure there who says he doesn't know anything about this. And of course, Jerome Powell was set to step down as chair, ending his term in May anyway. So it's going to be interesting to see how all of this plays out.
And you mentioned the 3, all three living
Yes.
former Fed chairs condemning this treatment of Powell.
There's only 3 that are still alive.
Yeah.
All 3 of them have condemned it, along with 4 Treasury secretaries. So it's really interesting to see the strong words coming out here.
Yeah. So, sorry to interrupt. I was just going to say Alan Greenspan, who was actually originally appointed by President Reagan, and then Ben Bernanke and Janet Yellen, the 3 chairs.
And interesting to note, too, Jerome Powell was actually appointed by Donald Trump. So it's interesting to see all of this come about. And, we're going to have to wait and see. But in terms of what the markets are doing today, we're seeing, as you've been mentioning, you've been talking about, we're seeing a slight dip, nothing too big yet, nothing too crazy. A lot of economists are saying you'd have to wait long term to see what could come out of this, particularly since we're in the first couple of days of this. But, we've had some economists say bond markets could react strongly to this. Of course, we're seeing the U.S. dollar dropping today. The price of silver and gold is going up. Obviously, a lot of people see that as a safe haven when the U.S. dollar isn't doing as well. And because of that, the TSX is also bumped up, mostly because of the price of gold and silver. The S&P 500, NASDAQ up a little bit at the moment.
Upwards,
yeah, so there hasn't been too much movement, but we'll have to wait and see whether there is.
Thanks very much, Lindsay.
Yeah.
As Lindsay noted, stocks up today. In fact, the S&P 500 and the TSX Composite hitting record highs. We'll have more after the break. So despite concerns over Fed independence, stock markets hitting record highs in Canada and the US. Let's get more from Art Hogan, Chief Market Strategist, B. Riley Wealth. Art, great to see you. Thanks very much indeed. I mean, this is the latest installment in this Trump-Powell friction, but it looks like the administration's stepping things up a bit here.
It certainly feels like that, although the administration is not taking credit for the DOJ actually lobbying those subpoenas over the weekend. But, it's pretty clear the motivation here. And it's a pressure campaign to get either Chair Powell to leave the Fed or leave the Fed after his chairmanship's over in May, and he could stay through 28 and be a governor. So clearly, another level of craziness in what has been an ongoing dispute between the president and the chair of the Federal Reserve. And clearly, the market reaction has much more to do with how much logic is being infused by everyone that's reacting to this today, whether you're a Republican or Democrat. Everyone's denouncing this action and reminding us the importance of a independent central bank, and that has a lot of historic precedence to it. The clip you ran with my friend Elizabeth Schultze earlier just talks about how this goes bad, and unfortunately in our lifetimes we've seen this with Arthur Burns and the Nixon administration, and the ramifications for that were devastating for the economy. You also can just look abroad at countries like Turkey that had lost independence of their central bank and skyrocketing inflation. So there's a lot of historic precedents to all of this, and none of it's good. But luckily, everyone's coming out denouncing this, whether they're a former Fed governor or a Fed chair or the Secretary of Treasury, across the aisle, both Republicans and Democrats.
Yeah, Hank Paulson, who served under President Bush, among the former Treasury secretaries, criticizing this. Talk about the markets, record high, so equity investors don't seem too worried. You say that projections for U.S. economic growth may be too pessimistic.
Yeah, so the average estimate for the GDP growth in 2026 by a consensus of economists still sits at 2.5%. And clearly, with the kind of productivity gains we saw in the last 12 months, and certainly with the amount of CapEx we're seeing, we think that's going to be north of 3%. Right now, the Atlanta Fed has a GDP tracker that has the fourth quarter coming in at closer to 5%, and that a lot of that has to do with imports and exports. So there's a bit of an aberration there, but the average is 2%. We think we're going to be closer to or north of 3% this year. I think that drives earnings growth. Estimates right now for the full year of 2026 sit at about 12% earnings growth on about 8% revenue growth. Both of those may be conservative as we get to the middle of this year.
We get reports from your big U.S. banks this week. You say the bar to impress investors is going to be high because a lot of them are at or near record highs.
Yeah, that's where things get tricky. So you come into reporting season, if either as a company you're trading at all-time highs or as a sector like the financials, which had a very good 2025 and have had a strong year-to-date performance, come in and report, that sets the bar up there. So even if you beat and raise, sometimes that's not enough, and you get that counterintuitive reaction function where things sort of settle in, take profits, and usually generates an opportunity to get back into a sector. We certainly have seen that over the course of the last 12 months in a lot of the artificial intelligence darlings, the mega cap technology stocks, where they report. NVIDIA is a great example of that. They had a spectacular report, and the stock hasn't done anything since then. So, but I think the important thing is, as we enter earnings reporting season, we're actually seeing earnings growth from sectors not related to artificial intelligence. So things like financials and things like health are coming in and throwing off great earnings estimates. We suspect that guidance for this year is going to go up, not down, after we finish up the earnings reporting season.
This threat by the president to cap rates on credit cards for a year, hard to know if that'll come to pass. The banks, one assumes, will fight it furiously.
Yeah, and it serves the wrong purpose, right? So if you're trying to help people that need credit, putting a cap on what banks can charge will take them out of the credit card environment. So banks aren't going to lend at a set rate for people that actually need the credit card. So that's only going to help people that don't need credit cards, and it's not well thought out, and I don't think it's something that ever gets passed. But it actually is a deleterious impact on the people that need credit cards the most.
I just want to break something here. Central bankers, of course, known for their caution, but our own Bank of Canada Governor Tiff Macklem has issued a statement saying he offers full support for Chair Powell, and he calls central bank independence critical. It's interesting that the Bank of Canada would speak out on a U.S. issue like that.
Yeah, I think it actually speaks to the point that central bank independence is sacrosanct, and that is something that needs to be protected, whether you're in Canada, the United States, or any central bank around the world. It's well-known economic theory and fact, and that's why you're seeing so much pushback by this. I think it's the right move for the central banker in Canada to do that, and I think we'll probably hear more from central banks across the globe.
I'm just looking. So we get back to the bank earnings. So it looks like we get JP Morgan tomorrow and then Bank of America, Citi and Wells Fargo on Wednesday. Is there anything in particular investors should bear in mind differentiating those stocks?
Yeah, well, those are all the large money center banks.
Yeah.
All of them have different portfolios of business. JP Morgan just happens to be the largest of those. I would look towards guidance over capital markets activity because that's picked up. We have a threefold increase in mergers and acquisitions that have been announced this year. Mm-hmm. We also see massive volatility in trading. So I think all the banks are going to fare well. And remember, we're still in a light regulatory touch environment, so they can do a whole lot more M&A activity internally with banks.
Yeah, it's interesting. Just back on the credit cards, maybe we could put up Delta, DAL, or United Airlines. I think it's UAL, because the airlines make billions of dollars selling miles to banks and credit card issuers. That's a huge part of their business now, a very high margin part. So if there was any curtailment of credit card issuing, presumably it would be bad for them.
Yeah, certainly. And that drives a lot of decision making for credit card users, right? So, we use the American Express so that we can get into the Delta Lounge and we do it. And, travelers take advantage of those things. And it's a big selling point. So to the extent that Visa and MasterCard are the folks that clear all of this activity, and the banks are the issuers of credit cards, you have to remember where they're coming from. And what's in your wallet really stands out as to what benefits are you deriving from this. And I think that it's not just the airlines, it's the hotels as well. Yeah. So I just think it's a very, very bad way to do something that you think is going to be positive for people who need help.
Art, thank you very much indeed. Art Hogan joining us there, Chief Market Strategist at B. Riley Wealth. Coming up, we are going to talk to the head of Canada's Association of Retirement People. They are not happy with practices on selling investments, particularly mutual funds, in big bank branches. Stay with us. The Canadian Association of Retired Persons says seniors rely on in-branch investment advice at banks, but it warns that in doing so, they're exposed to exploitation driven by a sales culture. Let's get more from Anthony Quinn, president of the Canadian Association of Retired Persons. Anthony, thanks very much for joining us.
Good afternoon, Andrew. Happy to be here with you.
So as far as I can see, the core of your concerns here is the mutual funds that are offered to seniors, in that your complaint is that seniors generally are just offered the bank's mutual funds and the bank's investment products and not rival products, not a full selection.
Well, this is based on a report from the CIRO and the Ontario Securities Commission that came out earlier or in the middle of last year, and they reported that, I'll just say 24% of their in-branch advisors sometimes recommended products that were not in their client's best interest. So that report from the OSC raised a flag with us, and we have been trying to make some noise with the regulators and legislators about that concerning report. I wrote a letter to Anthony Ostler, who is the head of the Canadian Bankers Association, and said, we would like the banks to self-regulate. This issue is affecting millions of older investors who have a very short runway to make sure they're getting the best returns on their investments. But it also affects younger investors who will have compounding lower returns when they are using these in-branch investments.
Yeah, it's interesting. I was curious. You're not just talking about seniors, but of course your job is advocating for seniors.
We advocate for seniors, but seniors are in the habit of trusting these institutions. Mm-hmm. Many of our members have been working with their banks for 50, 60 years. And when they have a portfolio of their nest egg that has been given to the banks, they're expecting the banks to be working in their best interest. And this report obviously showed that in many instances, they're not working in their clients' best interests. And we're asking the banks to take their thumb off the scale and be working with a higher fiduciary standard for those investors who come into their branches trusting their advisors.
Give us an example of where you think a senior may be not treated fairly when it comes to investments offered by a bank branch.
Sure. Let's say someone downsizes their home and they have several $100,000 now available for investment, they walk into their in-branch advisor, someone who they've trusted, or the bank branch they've trusted for decades, and they will be put into bank-owned mutual funds typically, and that is all they're going to be offered. If they happen to walk across the street to the same bank's wealth division, they would be offered the entire spectrum of mutual funds or ETFs or the things that would actually be in their best interest. So there is naturally a conflict in the bank infrastructure because they're selling the bank's own instruments exclusively, and they're being incentivized to do so. So that scorecard of the investors having to make the demands of their interbranch advisors is a concern for our members, and they were shocked to see what the OSC reported.
The banks did get back to you. There's Canadian Bankers Association. I have a couple of points that they made back to you. They said, well, this survey was just in Ontario, and they say, well, over 70% of respondents in the bank branches said, I think the range I can recommend of funds meets their needs. That's just two of the points they made. Any comments there?
Well, I don't want to blame the investment advisors themselves. They're working within the constraints of their jobs. But when the head of the CBA says that the report was only Ontario-based, that's where all of the policies and procedures are coming from. They're emanating from Ontario across the country. And that sales culture is clear across the country when it comes to in-branch advisors. So we're looking for the banks to really regulate themselves. We're talking to the OSC, we're talking to the provincial government in Ontario, asking them to step in if need be. But it would be much better if banks could increase the trust, rebuild the trust between themselves and their clients, and do the right thing before regulators have to step in.
Now, I'm not familiar with the morass of regulation here, but I assume it would be complicated if you had in-branch employees expected to be knowledgeable about a vast range of mutual funds, not just their in-house ones.
Well, I think the expectation from anybody walking in who's speaking to an investment advisor is that they're acting in their best interest. Whether they have access to every available fund in Canada or a larger amount of them, but if they're not acting in their best interest, if it's a suitability standard, as they call it, and it's suitable for the bank and suitable for you, that seems to be an unlevel playing field. And I think it's incumbent on the banks to really educate their advisors to what is actually in the client's best interest and to increase that fiduciary standard so that clients aren't just dealing with salespeople, that they're actually dealing with advisors who are working for the better outcomes for their clients.
We've only a minute left. The regulators obviously act at a glacial pace. Will some kind of self-policing really fix this problem that you perceive? I mean, because there's always going to be, unspoken pressure on a bank employee, for example.
Well, I think my goal is to get this out of the pages of the business newspaper, because this is an issue affecting Canadians on Main Street. I think the industry knows it's happening. It's very hard to get an industry that is benefiting from this relationship to change their ways, but we wanted to go right to the head of the CBA to ask them to make the changes. And then if not, we'll put pressure through grassroots advocacy to have the legislators and the legislators and the regulators make those changes if required.
Anthony, thank you very much. I really appreciate it.
Thanks for your time, Andrew.
Anthony Quinn, president of the Canadian Association of Retired Persons. Coming up, some suggested ETF trades for 2026, AI, gold, and Canada putting its elbows up. But we've got a twist here for you on all three. Stick around. The U.S. Department of Justice has threatened to indict Federal Reserve Chair Jerome Powell over congressional testimony he gave last summer about a Fed building project. Now, the U.S. President Donald Trump has previously blamed the Fed's policy for holding back the economy, and he has also spoken publicly about potentially firing Powell. Powell says the move is a pretext to gain more influence over the central bank and monetary policy.
No one, certainly not the chair of the Federal Reserve, is above the law. But this unprecedented action should be seen in the broader context of the administration's threats and ongoing pressure. public service sometimes requires standing firm in the face of threats. I will continue to do the job the Senate confirmed me to do, with integrity and a commitment to serving the American people.
Group Dynamite is raising its full-year outlook following strong holiday sales. The Canadian clothing retailer says same-store sales surged 31% in the fourth quarter. And there was also significant online revenue growth that outpaced brick-and-mortar sales. Store openings for the year are now expected at the high end of its forecast, with 20 new locations. China and the European Union have agreed on steps to resolve their dispute over the imports of Chinese electric vehicles to the bloc. The EU says Chinese manufacturers plan investments in the EU, and those will be considered. Both the US and Canada have imposed a 100% tariff on Chinese electric vehicles. This announcement comes as the Prime Minister, Mr. Carney, prepares for his visit to China this week. The big theme today in the markets, Donald Trump and his pressure on the Federal Reserve. But AI has been the big theme over the past year and more. Gold surging with uncertainty over U.S. monetary policy. Let's get more on how you could navigate this uncertainty. We're joined by Bipan Rai, head of ETF Alternatives Strategy at BMO Global Asset Management. It's great to see you, Bipan. Thanks very much indeed for joining us.
It's great to see you as well, Andrew.
Straight off, though, did you ever think you'd see something like this, a U.S. Government threatening to prosecute the head of the Federal Reserve?
Well, no. This is we're in uncharted waters insofar as the Federal Reserve is concerned. I mean, certainly you can point back to prior instances where we had a certain degree of palpable tension between the White House and the Federal Reserve. I mean, that's primarily a story from the 1970s, and of course, we remember that era for being notable for high levels of inflation and the like. And that's something that a lot of investors should think about in this sort of next era for monetary policy making in the United States. To what extent does that lead to unfavorable outcomes for the real economy?
And interesting, I thought that Tiff Macklem, the governor of the Bank of Canada, issuing a statement in support of Jay Powell, you think he must have considered, well, I'm just going to steer clear of that. It's an internal American thing.
I mean, if you look back across the last several decades, and certainly across the span of developed market economies, I mean, the Great Moderation, part of the reason why it was so successful in taming inflation was the fact that central banks made it a focus. And for central banks really to prioritize inflation and getting it down to more reasonable target levels, I mean, that requires a degree of operational independence from the fiscal side of things, and really moving away from that fiscally dominant era of monetary policy making that had been a few countries had been subject to that in decades past. So again, this is sort of the notion of an independent central bank. It's not a U.S. specific value. This is something that's quite common across most of the developed world as well.
Now, you have some ideas, ETF ideas. They are BMO ideas, but, we'll note that, for navigating the current market. You say that there is possibly a rotation going on from AI, but one option for people who want to keep a toe in the water here would be the Canadian, the BMO Covered Call Technology ETF, ZWT. Why is that?
Right. So we feel that, if we're looking at the AI space going forward, I mean, it still makes sense to be invested in the space. And I mean, sure, you can have this sort of talk about, AI being a bubble. In fact, we would argue that, it's moving away from being a pure beta play, whereas anybody investing in the space automatically, you'd expect their shares to increase. We think there's going to be more winners and losers going forward when it comes to capital expenditures, deployment of said capital in the AI space. It's a lot of the winners and losers, and what happens going forward from here is going to be dependent on, one, how that capital expenditure is financed. Is it, again, financed endogenously from operating cash flows, or is it reliant on external debt financing? And then two, it's also going to matter what the capital structure or the makeup is for a lot of these firms. So again, there's going to be winners and losers. And in that sort of environment where, say, pure beta takes a back backseat to more active strategies, we think there's room for covered call strategies that target the tech sector to potentially outperform while allowing investors to harvest a reasonably attractive yield as well.
Now, my Bloomberg screen is showing that I think this thing was launched in early 2021. And it's done pretty well. Total return of 150% in Canadian dollar terms, actually beating the NASDAQ 100. So often, you give up upside here, but it has, by my Bloomberg screen anyway, beaten the NASDAQ 100 over that period.
It has. And we can't look past the fact that we also do harvest a reasonably attractive yield as well, that it is also adding towards that the return profile for prices alone. So we do think that is also something that is important. And again, it's really the composition and the structure of that particular ETF. And that, again, we have to attribute to our top-notch portfolio management team.
Yeah, I was including the distributions there. Now, on Canada, we're going to face trouble. The Prime Minister said we were going to go elbows up, but we've backed down from a lot of the measures and dropped the digital services tax, trying to please Mr. Trump. So it could be choppy for Canadian stocks this year. You have a product, ZLSC, the BMO Long-Short Canadian Equity ETF. What's that one about?
So that's an ETF that, has done reasonably well over the past year. And that's, leveraging our abilities on the quant side to put up particular, say, frameworks or lenses with which to filter through Canadian or the universe of Canadian stocks and pick winners and losers. And again, there's...
Did we lose Bipan there, or is it me? Oh, sorry. Go on, Bipan.
I'm sorry? No, it's one of those screens where or at least one of those strategies where we tend to leverage, our intellect within BMO Global Asset Management, insofar as quants are concerned, and really optimizing strategies that filter through particular screens. And again, it tends to do reasonably well during an up year for the broader index, which is something that we saw for the TSX in 2025. Certainly something that we're expecting again in 2026. And again, this particular ETF should do well under those circumstances.
We're tight for time. You have another product, the BMO Covered Call Spread Gold Bullion ETF. What's the idea with this one?
Well, I mean, in this sort of backdrop where we're in this sort of space where we are a little bit leery about fixed income and the fact that it could correlate positively with equities more and more, again, if inflation remains elevated, we like holding gold as that instrument that is, a diversifier within the portfolio. It can mitigate some of the volatility. Now, of course, the long-term problem with gold is the fact that it yields nothing. So, again, if we have this covered call spread, and again, this is very different than a covered call strategy, this allows investors to participate one-to-one with the movement in gold, while also harvesting in yield as well. So it does bridge that gap between something that gold has been missing as a diversifier versus traditional diversifiers like fixed income. And that's something that we think should appeal to a lot of investors in Canada.
Now, I believe you just launched that one in May of last year, Bipan. It has over that period underperformed, but of course it's been gangbusters for the gold stocks. I'm showing a total return of about 33% for that ETF since the end of May of last year, whereas the XGD, a straightforward iShares ETF, is up almost 90%. So it has lagged over that period.
It has. I mean, it's also a function of the fact that gold prices have done extremely well over the past year. Now, if you're somebody who's sitting there and worried about the fact that gold is incredibly overbought, and certainly you can make a reasonable case there. I mean, certainly, the diversification appeal of it will still remain there, but that is offset if we do see a meaningful retracement in gold prices in 2026. Something like a ZWGD should shelter investor portfolios from that, given the fact that you still do harvest an attractive yield. So again, if we're having this conversation from, say, 10 to 11 months from now, Andrew, wouldn't surprise me at all if we have ZWGD that's outperformed.
That's interesting. And, you gave us a new ETF angle there, Bipan. I really appreciate it.
My pleasure.
Bipan Rai, head of ETF alternative strategy at BMO Global Asset Management. Coming up, hot picks in oil and gas, including a company that our guest says is well hedged while also providing a high dividend. That's ahead. On Hot Picks earlier, we focused on the oil and gas sector. We were joined by Aaron Bilkoski, analyst at TD Cowen, and we kicked things off with his top pick, Petro Exploration.
There's been an incredible amount of geopolitical uncertainty this year. This has created a ton of volatility. What I wanted to focus on today are a few names that are defensive to that global macro environment and have catalysts coming. Peyto absolutely checks that box. Peyto is a high-quality natural gas.
Sorry to cut you off there, Aaron. Yeah, I think you were going to say this, but they're a classic natural gas play in Canada.
Absolutely. 90% gas. They have assets in the Alberta Deep Basin. Peyto's momentum as a company really started to accelerate in 2023 when it acquired the conventional assets of Repsol. This was pivotal because these assets were very undercapitalized, and Peyto, being a high-quality, competent operator, applied its own field practices to these properties. And we're now seeing the benefits of that. The company has significantly increased the average well productivity on these areas and has driven costs down. And there's a few things that make Peyto really special in its class. It has the lowest corporate capital costs. It has the lowest corporate average gas expenses. Despite the fact it's primarily a dry gas producer, it has the highest full cycle cash margins when compared to its peers. And they have excess infrastructure. So they have twice the natural gas processing plant capacity that they need today. So while many of its peers are going out and spending capital on natural gas plants to grow, they already own these facilities. They simply optimize and fill what they already have. This means the business is generating significant free cash flow that's being redirected to single-digit growth, about 9% year over year, and a 6% dividend yield. Its cash flow is very stable, as you alluded to in your intro comments. It's about half hedged this year at a gas price at about $4. And as those hedges roll off the books, they should be rolling into a higher than current Canadian natural gas price environment as LNG Canada continues to ramp up. And hopefully as we start to see other projects come on stream, whether that's Cedar, Woodfibre, LNG Canada Phase 2, or Salisms.
Let's move on to your next name, ARC Resources. They too are well known for gas exposure. What draws you to that stock?
Yeah, so I think ARC is one of these classic examples where the market has overreacted to a relatively small disappointment in the field. So the background here is that ARC has been building out a new area called Attachie over the last couple of years. It was supposed to ramp up to about 40,000 BOE a day. Unfortunately, it's been tracking about 30,000 BOE a day. Quite honestly, it's been an uncharacteristic hiccup for a really high-quality operator, ARC. But I think we need to put that hiccup into the context of the broader business. ARC's producing over 400,000 BOE a day. We're talking about a shortfall of less than 2% of the company's production. Yet its share price has underperformed its peers by 30% since these challenges came to light mid last year. It doesn't change what makes ARC differentiated or special. ARC is the single largest Montney pure play in Canada. It is the single largest Canadian condensate producer. They're the only Canadian independent with a direct supply agreement to LNG Canada. Plus, they've signed a basket of future LNG deals with Cedar LNG here in Canada and Cheniere in the Gulf Coast. So as I look ahead, I see a share price that's well supported by healthy free cash flow. At current pricing, they're paying a 3.5% dividend yield. They can repurchase about 2% of their shares outstanding with excess free cash flow this year. While we wait for more data points that show improvement at Attachie, or the market to more rationally price in the small challenge at Attachie, and as I expect, Canadian natural gas price fundamentals to improve as LNG Canada continues to ramp up.
Attachie is what? It's a crucial price setting point for gas?
No, Attachie is a Montney area in BC. It's a condensate-weighted Montney area that they've been building out for a couple of years now.
Can we move on finally to Prairie Sky Royalty, where we're looking at a yield of about 4%? Is that one of the things that attracts you here?
It's one of the things, but I think bigger picture, owning energy assets through royalty entities is a fantastic option. This is essentially the same way governments around the world receive value from their oil and gas resources. So in its simplest form, Prairie Sky owns mineral interests across about 20 million acres of land. A large portion of that is held in perpetuity, and it's Prairie Sky's job to lease out that land to oil and gas companies who do all the field work and assume the risk. So Prairie Sky simply takes a portion of the production on its lands. This means, unlike traditional oil and gas companies, Prairie Sky has no reoccurring capital expenses, no operating costs, no transportation expenses, no end-of-life abandonment expenses. Outside a small amount of G&A and corporate cash tax, all the revenue they collect is free cash flow that's used to pay dividends, buy back stock, or make tuck-in acquisitions. So despite all those benefits relative to a traditional E&P, PrairieSky currently trades at a free cash flow yield of about 5.5%. That's better value than the Canadian integrateds or the Canadian conventional E&Ps, which trade down to about 5%. Personally, I think this is just a fundamental mispricing of risk. So from a shareholder's perspective, you're right. You're getting roughly a 4% yield, but also they're growing the business about 4% year over year without investing any of their own capital.
Aaron Bilkoski, analyst at TD Cowen. Still ahead, we're going to turn attention to global markets with Bloomberg's Natalia Kiniszewicz. Know Your Options is back. Tune in Wednesday at 3 p.m. Eastern to get all of your options trading questions answered by Chris Tom of Moat Financial. Send your questions right now to knowyouroptions at bnnbloomberg.ca. That's this Wednesday at 3 p.m. Eastern. Let's get some stock movers south of the border. We are joined by Bloomberg's Natalia Kiniszewicz. Natalia, great to see you. Thank you very much indeed for joining us. Remind us what's going on with the big U.S. bank shares today.
Hi, great to see you as well. So yes, we're keeping an eye on banks' shares. So for example, one of the most notable movers today is shares of Capital One. This is one of the biggest U.S. credit card issuers. Of course, volatility came after U.S. President Donald Trump said that credit card companies should cap interest rates at 10% for a year. So as of now, credit card interest rates are hovering at around 20%, and lawmakers on both sides of the aisle are trying to bring them down. Now, of course, we looked at how analysts reacted, and Mike Mayo from Wells Fargo, he said, first of all, that could wipe out earnings from cards for a year. And also, he said it could disincentivize some big banks to keep lending. And of course, he mentioned that consumers from the low-income cohort could be one of the biggest losers. So when it comes to financial sector, he also highlighted that could be winners, actually, because if less companies, less banks are lending the money, maybe there could be more demand for the so-called buy now, pay later. And companies like Affirm or Klarna, they could see some, increase of demand for their services.
Abercrombie, investors not happy there.
Not happy. So this is a retail sector, consumption and shopping. So this stock reaction came after the company said that sales during the Christmas period were not as robust as the company expected, and that, of course, could kind of impact full year sales. And the company also said that it now expects fourth quarter sales growth at around 5%. Previously, it expected it to be in the range between 4 and 6%. Notably, just in November, the company was really optimistic because it saw really strong demand during back to school category, and they were pretty optimistic. But again, it just shows that consumers are becoming more selective.
And then Medline just went public. Remind us what they do and what are the analysts saying about the stock?
Yeah, so Medline, that was the biggest U.S. IPO this year, which happened in December. So this company is a medical supplies, basically, company. It's a very big and very old vertically integrated business that supplies stuff like gloves or medical exam tables for hospitals and doctors. So it's a strong business, very profitable. The stock spiked by 40% after its IPO. Now, today is the first day when analysts issued coverage on the company, and I have to say that it's largely positive. 27 analysts initiated coverage, and most of them have buy ratings, and they see strong demand for services and really strong margins.
Thank you very much, Natalia. I really appreciate it. Great to talk to you. Natalia Kiniszewicz of Bloomberg, thank you very much indeed for watching this edition of Trading Day.